Hello, this is Mike Swanson of WallStreetWindow.com. I got a very special guest with me today. I'm speaking with Lior Gantz, who runs the website wealthresourcegroup.com. How you doing today?
Very well. Thanks for having me.
Yeah, definitely. And it's been probably about a year since we last talked, and it's been an interesting time. I mean, a year ago, the stock market was going straight up. Donald Trump had won the election in 2016, and the stock market didn't even pull back no more than 5% at any one time last year. And, people were seeing the rally as evidence of, the Trump policies were going to boom the stock market, boom the economy, and he was tweeting to that effect. And then this year, we went up for a couple weeks, but now the Dow's pulled back about 10% as we're speaking. We're sitting right on the 200-day moving average on the S&P 500, right around it. And people are wondering, I think, two things. One, is this drop real, or is this like some sort of fake news? And is this a time to buy or be even more cautious going forward? What do you make out of this stock market volatility?
Well, first of all, I don't think that the stock market has peaked yet. For stock markets to peak historically, you need to see a real sense of euphoria. We haven't seen genuine euphoria yet. We've seen something close before this correction happened, but right now with the tax cuts and with the guidance coming out of CEOs, especially in the S&P 500, they're all going to post just stellar earnings going forward. Most of them are doing record earnings, at least for this decade. So you got to figure with all the tax cuts that have happened, stocks are back to about 2015 levels in terms of valuation. So they're not cheap, they're not expensive, but it's certainly not the end of this bull market. It's a correction, and then we now test the lows again. And the fundamentals for this to continue are there. The reason I'm saying that is because CEOs can keep borrowing at very low costs, very low rates, and repurchase their shares and improve their earnings per share. And the bonds market the bond yields are not that high that pensions funds will switch over immediately to bonds over stocks. So there's still plenty of reasons for stocks to move forward, especially when you consider that the previous bull markets ended with the NASDAQ being the leading index, and right now it's the one suffering the most severe correction. So I still see lots of room. In fact, for the Dow, it could go up about 50% from here on. And it wouldn't take a lot for that to happen. So in 2018, 2019, 2020, what I see is many corrections. So figure 4 or 5 more of these rough 10% corrections, and then like a month and a half later, the market rallies again, and so on and so forth. Remember that in the last bull market, the last big bull market, we had about 5 corrections in 1 year of over 10%, and the 1999 rally. So it's perfectly normal, and it doesn't mean that I'm buying. It doesn't mean that I'm buying stocks or the index hands over fist. Like I told you, most companies are not cheap. So the fact that they're cheaper doesn't make them cheap. I am very selective with what I'm buying right now, and I would say that this is where I put the 2018, 2019 going forward.
Yeah, it's interesting to hear, you say that. We've had this drop, and nobody I know actually predicted the peak in January before it came. Nobody, that I know of at least. So I think it's kind of woken people up, and people are trying to figure out what exactly is going on. And, you see people like Harvey Dent, he's calling for a complete and total collapse and to send gold down to like 400 an ounce and all kinds of stuff. And it's good to hear some more level-headed talk, in this type of environment of extreme.
It's important, Mike, it's important with all of these predictors and doomsday commentators to put some sort of an expiration date on their projections. I'm hearing over the years since 2009, I've heard so many predictions. The most forecasts tell you more about the forecaster than about the future. So it tells you about their personality and about what their view of the world is. But if you follow forecasts, I would say roughly 1% of them ever comes true. So, but they do sell books, they do sell everything, and they're very sensational. It's just it's important to look at facts and look at what happened in previous times. In the 20th century, we've seen 2 world wars, we've seen breakouts of flus, influenzas, oil shocks. You name it, it was there in the 20th century. But the stock market has returned about 8% year over year, just with a simple click of an index fund. And 8% year over year, it doubles your money every few years. Every 8 to 10 years, you double your money if you compound and reinvest your dividends even faster. So the stock market is your way of participating in the fact that the world is getting richer. Whether or not you're getting richer, your own wage, your own labor is being valued more every year doesn't matter to the market. The market in the world is becoming much more valuable year over year. And the best way proven to get involved in this is to own businesses or companies. So many people try to do it privately, buy equity in private businesses and start their own business. But it's, like I said, it's very important to understand that if you open a business, it doesn't mean that you're going to ride the wave of prosperity that the world is enjoying year over year. But if you buy the best businesses in the world, then yes, you will enjoy prosperity with the stock market. That is the formula for passive residual income. Again, it's very important to differentiate this from, for example, holding cash. Cash does not participate in the growth of an economy. It does not create any value. It does not create cash flow. It does not create profits. It's not dynamic. Compare that to a company, for example, like the wealth stocks that we cover on wealthresearchgroup.com. If you go to our website, on the top menu, you'll see wealth stocks. One of them, for example, is a company, very, very stable company, safe company, called Archer Daniels Midland, ADM. It's a dividend aristocrat. And from 1980 until today, it has outperformed all the major indices. It's a food company. Very simple. They manufacture food and they distribute it. That company, because it's one of the most well-run companies in the world, has participated in the growth, in the boom. Didn't need to be an expert on tech to understand that when demographics grow, when economies grow, when populations grow, then they need food. And if you find a well-managed food company, then you can make a fortune. So compare that to a real estate holding. You buy real estate. What happens to that bricks and mortar investment? It creates a yield out of the rental income, but the house itself doesn't grow every year. It's not like it's the house is getting better, and therefore real estate is not as good as stocks, businesses that can open new markets. They can get into increase their product line, etc. So at the end of the day, I'm a very, very hardcore bull on stocks, and The most important thing is just to know how to invest in them. And countless examples, Mike, of people starting with very, very modest amounts and retiring with being the millionaire next door. So if you know what you're doing, the stock market is just the ultimate spot. Obviously, for secondary income, your main income will always be your own career or what you are doing. That will always be the number one most important thing in your life. So just to make sure that people understand my priorities.
Yeah, I mean, I've seen amazing things in the markets. I mean, I started out in the 90s and saw that bear market that really wiped a lot of people out, but not so much. It was really the one after that caused many people I know to actually close their accounts and give up forever. And people, I think, need some sort of plan on how to do all this, and most people don't.
I have an amazing story for you,
Look at their
Mike.
account balance.
When 2008 happened, during those panic days in September of 2008, I was rafting in the Green River in Colorado with no cell signal. So when I, left the river back to civilization, the panic has already happened, and that made me come in late into the panic. I didn't share the panic. I wasn't part of it. And it gave me such a different state of mind, because I was thinking, okay, I went rafting. 4 days later, the world has ended, but nothing fundamental. What happened? What happened to, for example, one of the companies that I invested in right after the crash was 3M, a manufacturer of industrial goods, from anything from sticker notes to pens to medical equipment, etc. What happened to it in the last 4 days that I don't know about? What has made me think that this company is worth 10%, 20%, 30% less than 4 days ago? And the fact that I wasn't part of the panic helped me, because I didn't sell anything. And since I was liquid, I was fortunate enough to buy in 2008 and accumulate shares. So, the bull market from 2009 to today, we're well above the prices that we were back then, and just holding to the best companies, not to some companies, but to the best companies, has proven to work time and time again. It's just important to understand what you're holding.
Yeah, definitely. And I think that might be the big lesson people may need now is, last year everything went up, and now there's some stocks that they're falling below their 200-day moving averages, way below them. I'll just name Tesla and Facebook, and
Sure.
And I don't think Facebook's going to go bankrupt or something, but obviously, it's got a cloud of bad news on it, much like Microsoft did a long time ago, and the cloud lifted. But the stock lagged for a long time, but Tesla, who knows what the future of that one is? But last year these were great stock. Both of them have been among the best stocks in the market until now. And I think people need to be careful, if they're going to, is Tesla still a good investment? There's probably better investments in the long run, I think. But people need to be on top of this stuff.
Yeah, I actually have never owned Tesla. Thought about a few times about shorting it, but I don't invest in companies that I don't understand and that I don't understand their competitive advantage. I rather stick to very boring industries where my competition is scarce. Many people do not even consider owning an insurance stock in their entire lifetime. My portfolio is loaded with great property and casualty insurance companies. I go for where it's boring and the expectations are very low, because that means that the prices are very attractive. And when stocks stay attractive for decades, yet they are in slow growth, then they outperform the market. I don't know if you know this, but Since the 1950, the best performing stock in the world has been Philip Morris, the manufacturer of Marlboro. Whether or not it's ethical or not to invest in a cigarette company is beside the point for this discussion. What's important to understand is that single stock has outperformed Warren Buffett. So if you were a worker of Philip Morris back in the 50s and you said, damn, this company is making a product that other people are addicted to, we're going to grow, Marlboro is going to grow, I'm an employee of this company, I know what's going on, I'll just put $1,000 into the company that I work at. Well, you would be sitting on more than $5 million today from $1,000. And why is that? Because the cigarette industry had faced backwinds. So you remember, obviously, in the 80s, what happened to this industry. They thought that it was going away with the exposure of the nicotine and everything like that. But people kept buying. Fundamentals were very strong always for this industry, and therefore Philip Morris compounded at a 21% a year yield. Warren Buffett has compounded his wealth at 19.7. So there's an example right there of how these things work. And what I'm trying to say is not invest in Philip Morris, but more so look around you and invest in things that you know. Because any smoker, any person who smokes could have figured out that the better decision, instead of smoking, is investing in Philip Morris. Instead of buying their products, invest in the company. And that's what I think people need to understand with investing. You need to keep. Do have 10% of my portfolio always at what I call play money. Companies have either a huge potential or they can go sour and I'll take my losses. But that's only with 10% of my portfolio. And the rest of it, I don't gamble at all. So that's kind of where my mindset is. It's worked out fine for me. I'm 33 now and been investing since I was 16. And I'm now a full-time investor with Wealth Research Group. This is basically my way of sharing the research that I do with a wide audience, and it's my baby. It's my labor of love. So it's completely free, and that's just where I'm at.
Yeah, well, thanks for taking the time to talk to me and the people that listen to my show, and recommend people check out your website. I'm going to do that myself and follow your future ideas, because this is an interesting time in the markets when they start to swing up and down. That does provide all kinds of new ways to get into new situations that wasn't there a year ago.
I would say, Mike, the one thing that does concern me is how the Federal Reserve will handle the inflationary pressures that are now being felt. I wrote a special report on wealthresearchgroup.com/portfolio, and that's like my asset allocation breakdown for 2018 that you can access and download. But on top of that, I wrote another exclusive report called wealthresearchgroup.com/bonds. And it talks about the fact that rising interest rates coupled with inflation is the worst cocktail for bonds. It decimates them. It happened in the 60s and 70s, and it might start happening as early as next year. And I think that is something that could really drag down the global economy. That's the one thing that troubles me most, because the Fed on one side will need to keep raising interest rates, but there's a limit to how much they can do. They're lying to the world by saying that they can raise interest rates on the Fed fund rate to about 3.5. There is no way in the world that can happen. And therefore, at some point, if inflation becomes a problem, they won't be able to keep raising rates like they did in the 70s. And I think at that point, inflation can become a problem in the economy, and that can really hurt the stock market It can hurt real estate. And the only thing that does flourish in that kind of environment would be gold, silver, and commodity-related companies. And I think that will be the best time, probably since the year 2000, to get into the gold shares, the gold equities. So keep an eye on that. Definitely, we'll update this on the newsletter as it happens.
Definitely, that's something situation I'm watching too. I actually have short positions in the bond market, not treasury bonds, but various corporate bonds. I'm not going to go into all the details on that. But thanks for taking the time to talk to me, and we'll catch up again in the future.
Thank you very much, Mike.